minutes.
Thank you, Madam Chairwoman. Chairman Powell, welcome back to our committee. And I want to first touch on your testimony about the importance of fiscal policy in supporting the economy. In general, what would you say is the lag time associated with a major change in fiscal policy?
Well, it can tend to be long, as you know. With monetary policy, we can go into a room and change interest rates, and do. Obviously, fiscal policy tends to take a lot of work and some time.
Well, let me ask you this. Let me ask the question this way. Fiscal policy has changed profoundly in the past 3 years. Tax cuts, deregulation, a less restrained energy sector, a pullback from Dodd-Frank, repeal of the individual mandate, new trade deals. Are any of these policy changes impacting current economic conditions?
I'm sure they are, but of course we don't try to assess that. That's not really what we do when we look at the economy. But yes, they would be affecting.
As you noted in your testimony, the U.S. economy is presently exceptionally strong. Since the 2016 election, 7 million new jobs have been created. The unemployment rate is at a 50-year low. More Americans are employed today than ever before. Wage growth is the highest in a decade, and the lowest income workers have been seeing the fastest pay increase, growing at 16% since the 2016 election. And just over the weekend, this was the headline of the Wall Street Journal, which I'm sure you follow, and the reporting was that a tight U.S. labor market is drawing Americans off the sidelines at a record rate. Despite this, after last week's State of the Union speech, Speaker Pelosi said that it was, quote, appalling to hear the president, quote, try to take credit, unquote, for an economy he inherited. Now, Chairman Powell, I'm not going to ask you to weigh in or arbitrate a domestic political dispute, but when the FOMC conducts monetary policy, given what you said about the lag time of fiscal policy, is it fair to say that this president's policies are impacting today's economic conditions?
At a high level, of course they are.
Let me follow up on Representative Wagner's question about the GSIB surcharge. In your response to our letter, you maintain that you aim to have the, quote, key components, unquote, of the stress capital buffer finalized in time for the 2020 CCAR. Can you describe in more detail what the key components are and a more precise timeline, given that the Fed announced last week scenarios for the 2020 CCAR?
So I think the timeline is we do intend and will put into effect the core of the stress capital buffer in time for the 2020 CCAR cycle. So that's coming right up. I'd prefer to leave the exact details of that to they're still being worked out, but it will happen in a timely way for the 2020 cycle.
Understand. Well, let me try to get just a little bit more detail. Is it still the Fed's view that the activation of the countercyclical capital buffer is a suitable replacement for the dividend add-on in light of the board's financial stability report from November, which stated that the vulnerabilities have not significantly changed?
We haven't made a decision on that, on using the countercyclical capital buffer versus the other approach. We have not made a decision on that.
Okay, thank you for that. We're looking forward to that decision. Final question. The Business Roundtable, as you probably remember, announced last summer that it was redefining a corporate purpose to elevate so-called stakeholders ahead of shareholders. A large investment firm recently announced its intent to divest of fossil energy, effectively limiting investment options for clients to a subset of sectors that check the environmental, social governance box. I am concerned that firms which arbitrarily limit investment offerings based on social and political pressure may choke off capital to perfectly legal, productive, and profitable sectors of our economy and cause retail investors to miss out on returns that they need to fund their futures. As a leading voice on the Financial Stability Oversight Council, will you commit to raising this issue with your colleagues at FSOC and urge that body to examine the extent to which a misallocation of resources away from shareholders to serve unrelated political errands might stifle capital formation, compromise investor returns, and ultimately undermine financial stability?
I don't know that I totally understand your concern, but I'll be happy to discuss it with you.
Well, the concern is that if shareholders are not a prime concern of corporate boards and directors, if stakeholders who have no ownership interest in the company are the focus of a corporation, then I would submit that there is a tremendous risk of misallocation of resources away from maximum shareholder returns. And I would like FSOC to take a look at that.
The gentleman yields back.
I will bring that to the authorities at the FSOC.
Thank you. I yield back.
Gentlewoman